with that PPI number, 7.8%. That was slightly higher than the market was expected. So really doing different things to what we're seeing coming through in consumer inflation at this stage.
Yeah, absolutely the opposite end. Consumer prices coming in lower than expected. Certainly again lower than I expected, and PPI going in the other way. And PPI is a bit of a lead indicator for your CPI. So I think we're getting to the end of the downward drift in the CPI, because it's getting to the point where commodity prices overseas and also in our local terms are starting to pick up a little bit. And we've probably had the big food price deflation behind us at the moment, as we see pick up in wheat prices around the world. Not maybe all food prices yet, but certainly in some of them.
Well, yesterday with that CPI number that surprised to the downside, coming in at 3.5%, many said that perhaps opening the door for another interest rate cut. Given that this PPI number surprised to the upside, do you think that sort of changes perceptions, perceptions of what could happen on the interest rate front?
Not 100%, but I think everybody from what I've read is sort of saying the chances of another rate cut are there, but they're still in the minority. Let's say give it a 30% chance, whereas no change is 70%. But I think what the PPI is saying to us is that you must start thinking that if you're going to do any long-term projects, that rates are likely to turn sometime next year. Not this year, but say middle of next year or whatever, when the CPI starts feeling the effects of a higher PPI. And the other factor the higher PPI brings is that we use the PPI to deflate our rand, actually. Yeah. And with that gives you an idea that the costs in South Africa are increasing tremendously quickly compared to the international arena. And with a strong rand, it makes us less competitive. So that's one of the things that's also the PPI is telling us outside of the direct consumer and interest rate related things. It tells us in the real economy there's real price pressures out there, and that firms, because these are factory gate prices, are struggling to compete internationally, specifically with a strong rand.
I mean, with the rand at these levels, and some economists are reckoning they could go stronger down to 680 against the dollar. I mean, how would that temper your inflation outlook going forward? And if we had it remaining at these levels, do you think we could actually see CPI going down to the very bottom end of the target?
Parts of the CPI are certainly not related to the PPI, but certainly the stronger rand has a very big weighting, about 30% weighting or so, on the CPI. But there are other factors. Labor costs have gone up tremendously. The PPI going up at 7.8% says to me that the overall inflation in the economy, not just the consumer price inflation, as was the case in the second quarter, is closer to 7%. And that says to me that it's unrealistic to expect CPI to remain at these low levels going forward. And I think that's one of the things that will come through in data sets, but still probably a few months away. I think I've been surprised more by the downside of the CPI in recent months. In fact, I'm getting to the stage where I find the sort of actual level of the CPI a little bit unbelievable.
Mike, you mentioned that with the CPI we don't import inflation when we have a very strong rand, so that's a positive element. With the PPI, a strong rand could be negative. So essentially, we're obviously looking for a balance when it comes to the local currency. We're sitting at around 696. We saw 692 yesterday. Is that the biggest risk right now for the South African economy?
Well, I would say it is one of the risks, certainly on the production side. But we must remember something about South Africa. 70% of our exports are still in the main commodities. Whether agricultural or whether it's a manufactured commodity such as steel, it doesn't matter. And the fact is, there we're price takers. It's only 30% where we actually are going to struggle with the strong rand, apart from the cost pressures on the others. This is where we struggle to sell. So that will have an impact eventually on our exports. But where the big thing comes in is that our consumers are very likely to import things. And let's take things in South Africa that we do import. A cell phone. We use cell phones every day. Every one of them is imported. Television sets, people watching us right now, that's an imported item. The majority of the car parts are imported in South Africa. So there's a heck of a lot of stuff that's imported. And that's where the low consumer prices are certainly having a positive impact on the wealth of our consumers. Make no mistake. And also the wealth of our investors. If you take your rand now, it buys you so much more internationally in assets and whatnot. So actually a strong rand benefits consumers and investors. The producer side of the economy is where some of the problems are. And certainly many of the manufacturing concerns right now are struggling. And that also has an impact then on your employment levels. And the one thing that doesn't gel with all of this is that we've had these high rises in the price of labor in a period where we have low inflation, we have a strong rand, and yet we've given people very big increases, and that makes us even less competitive. So some of the decisions that we as a country have taken don't gel in the current set of circumstances that we have.
Well, you mentioned, of course, 70% of our exports are commodity related, which of course has been supporting our trade balance over the past few months with demand coming through from China. We're getting those trade numbers out again, I think at 2 o'clock this afternoon. Market's still expecting a surplus because we have seen quite a few big surprise surpluses.
Absolutely. I think one of the unwritten success stories at the moment is that we've got a very big commodity boom still going. Well, that's been written about, but I think that impact on the South African trade balance has been much more positive than we think. And it's very much a positive story like the CPI is. It does have a negative on the PPI, as we've spoken about. So I suspect that we'll get a small positive balance, but even if we don't, these figures are notoriously volatile month to month. I mean, we get very big changes, but overall I think the trend is that we're going to have a very low current account deficit. And to say that the current account deficit of 2.5% was because of the World Cup, but at the same time the Reserve Bank says only about 3.5 billion income from the World Cup says to you that actually the deficit, on the small deficit that we did have is certainly not due to the World Cup. It's more due to the commodity price boom. So it's likely to last for quite some time. And that gives us an idea that the rand might remain stronger for longer, which is a position many economists, including myself, have had to change their positions because we got so used to always having a weaker rand. We now have to get used to having maybe a stronger rand for a lot longer.
Looking at the trade numbers, because they also have quite a big impact on currency movements on the day. Are you talking about perhaps a surplus coming through? What impact do you think it's going to have on the local currency? Do you think it could push us stronger?
You know, the one thing I've learned over the years, 20 years and working with the trade numbers is I don't think they actually have that much of its own. It's a trend that people watch more so than the actual numbers. Here and there it's had an influence, but I think people know and are well educated about the South African market, that the trade numbers, yes, they're interesting, yes, they're important, but the actual movement on the day of that currency is very little, unless there's a really, really big surprise, has very little to do, because we all know it's a very volatile number.
Well, although we've got inflation quite low at this stage, consumer inflation, interest rates have come down 6 percentage points. We've got that private sector credit extension still relatively low, so it came in at 2.98%, but there were some factors in there that really pushed it higher than expected.
Yes, I think, you know, my feeling is on our private credit extension is that it's underestimating something else going on here. And that is that people have moved where we've seen, for example, mortgage bonds. Now, yes, the numbers look low, but the volumes are starting to increase. And the reason why the private credit still looks smaller is that the amount of deposit that people put down today and compared to a while back is a lot higher. And yes, it's a lot lower than was maybe in the beginning of the year or the end of last year. That certainly is playing a role. But I think the low interest rates are also playing a role, and that more people are paying back their bonds a lot quicker because of the scares that they've had. But recently, I think we've seen a tick up in new credit extension into the South African economy, which is at least a positive sign as well. And I think that's something to write home about.
Well, just looking at what the kind of demand scenario that has been playing out with credit in South Africa, we were in negative territory, we're now slightly in positive territory. Do you think this is going to be a new normal, sort of, you know, very flat, but at least slightly to the positive? Do you think we could uptick extensively?
We're probably in a new normal for the next year or two, but in the longer run, probably not. I mean, banks also got a scare, so did consumers. And, you know, where we get to the point where people are not just jumping back into credit, but there is a demand, because from what we hear from some of the bankers, for example, are saying to us, and the motor car dealers, not everybody's thing is getting approved. So where the banks are still a bit scared of approving loans at the moment because of what we've gone through and their balance sheet have to repair themselves. So the new normal, you're right, is for the next year or two, but we'll get back into the cycle where the banks get back to doing their job lending. Part of the problem in South Africa at the moment is lowering interest rates is not going to exactly have a big impact on the private sector credit extension, because banks are still scared, consumers are still scared, so there's still an amount of fear, if you wish, in that market at the moment. So that part still has to go away. And that's why interest rates are not going to play a large part in the growth story at the moment. I think it's a story where people have to get their balance sheets, both private households and the banks, back to a more even keel. That will probably take another 12 to maybe 24 months. But it's a medium-term thing. Longer term, I think we go back to that 10, 12%, 14% credit extension over a year type of growth. That would be the back to the normal.
Well, you mentioned the positive balance of payments and the effect that could have on the current account deficit. How about the budget deficit, though? Because we're getting government financing figures out later today. And in the meantime, those wage bills that we've seen coming through from the public sector, that's really going to be pushing up the government's wage bill going in towards the end of the year. What sort of effect is that going to have on the budget deficit?
Very interesting question, because I didn't really think about it. But I think this month's figures still won't have the higher wages in, because that agreement hasn't been signed, and government is trying to act unilaterally, but the unions have refused that. So I don't think at the moment that's going to have an impact. But you're right, by the end of the year, we're probably going to see a bigger deficit starting to come through because of the higher wages in the government sector, and that certainly could play a role as to how people view South Africa from overseas. But again, it's not going to take 1 month of changes. It's going to take that trend changing. But I think what's important here, I think, is that what people want to know is, are we going to head to a situation in 2 or 3 years' time again where the budget deficit becomes smaller again? But in the meantime, yes, you're probably right that by the end of the year, the risk is that we have a slightly higher deficit because of the wage bill from government.